Hello everyone, this is Mario Giganti, author of the book The Retirement Bullseye, giving you proven strategies to save more now, invest wisely, and retire on time with a paycheck for life. Today we're going to talk about the invest wisely part again, and a concept that I'm talking a lot with today with both personal clients and employees of retirement plans called asset allocation. And why do you do that? So the first thing I want to talk about is that anytime you don't put all your money in the stock market and the stock market goes up for a number of years, you're going to underperform the stock market. It's an absolute fact. And that typically happens when we're in this type of cycle that we've been in for approximately the last 6 to 10 years. Don't know if we're at the end of this bull market. I really have no idea, but we're definitely at the latter stages. And it's really when my clients start to question whether or not they should be diversified or have asset allocation. So real quick, what is asset allocation as advisors define it for you? It's really diversifying your money, not having all your eggs in one basket, so that when the stock market goes up, some of your portfolio doesn't go up as much. And when the stock market goes down in those recessions or what we call bear markets, part of your money doesn't go down as much either. However, if you look at most 10 or 20-year rolling periods of time, having about 60% of your money in the stock market puts you in about the same place value-wise as having all your money in the stock market. And right now we hear a common theme, and we have labeled it in the advisor community something called FOMO, the fear of missing out. And it's really envy and greed at work at its best. And it's when you look backwards and you say, wow, over the last 6 to 9 years, had I just put all my money in the stock market, I'd be this far ahead. I might not have to save as much. I might be able to retire early. And those are all great things to think about. But think back 6 to 9 years ago. Were you really willing to do that? Would you really have put all your money in the stock market? So that idea, that fear of missing out, is really something that drives people today to really question and wonder whether they should be diversified or whether they should have asset allocation. And I think we're going to do a future video on this next topic below as well. So what does that mean? Well, if you think about what I call the funky math of investment returns, if you start with $1 and you lose 50%, which can happen in a stock bear market, you're left with 50 cents. Now, you lost 50% of your money there. What does it take to get back to the dollar? Well, it takes 50 cents. So wait a second. You're saying that I lost 50%, but it takes me 100% just to get back to even again. Exactly. Anybody can do that math, and everybody that's been through it knows what I'm talking about. If you started in 2007, you probably didn't recover again until 2012 or get back to even if all your money was in the stock market. Now, the best way over the last 20 plus years that I've ever explained asset allocation in an analogy form so that you can understand goes something like this. Let's say that you have a wedding in 10 days out in California, and you're in dreary old Ohio right now. It's winter, it's snowing outside. I can't wait to get to California for this wedding. So you got 10 days to get there. I give you 2 choices, and you're going to drive. You're actually not going to fly. You're going to take a Ferrari, or you're going to take a Ford Taurus. Well, most everybody's going to select the Ferrari, right? It's fun to drive. Never driven one before. It goes really fast. Now I give you 2 stipulations on that. One, if you're in the Ferrari, you have to go as fast as it can go. Now, I'm not a car guy, but I'm guessing that's probably 120 or 140 miles per hour, maybe even more. Now, if you're in the Ford Taurus, you got to go 5 to 10 miles over the speed limit, and you have to set your cruise control. Now, I gave you the goal of getting there in 10 days because that's when the wedding is. Think about that the same way with your retirement. If you take the Ferrari and nothing goes wrong, you'll get there in 5 to 6 days, way ahead of time. And you'll have a lot of fun getting there. If you're in the Taurus, you'll get there in 8 to 9 days. Still early, the drive might have been a little bit boring, but you might be able to see the scenery a little bit too. Now, let's think about what can go wrong. Now, if you're in that Ferrari, driving as fast as you can, obviously you can get flat tires easier, you can get a bump in the road. You can get a speeding ticket. You can get in an accident, and that accident either damages you, damages the car, or both, and delays your trip quite a bit. Whether you're in the hospital or your car's in the shop, And worse yet, when you go that fast, I'm sure most of us can agree that we bring in the risk of possibly dying and not getting there. But either way, we likely run the risk of delaying getting there on time. Now, all that can happen in the Taurus, but think about it. It's far more likely to have bad things happen in the Ferrari than it is the Taurus. And when something bad happens in the Taurus, it won't be as severe. Okay? Either way, we probably get there ahead of time, but we have a higher probability of making sure we're there on time if you're in the Taurus. So now think about that with your retirement, whether it's 10, 20, or 30 years away. Do you want to be in the Ferrari and get there early, or never get there at all and have a lot of bumps in the road that could potentially derail your success? Or do you want to take the Taurus or have asset allocation and make sure that you have a really high probability of getting there on time, probably a little bit ahead of time, and make sure that you can retire with a paycheck for life? If you have any questions on this, please give us a call at the number below, send us an email at info@ccadvisors.com, or simply respond to this video blog. Until next time, this is Mario Giganti, giving you proven strategies to help you save more now, help you invest wisely, and help you retire on time with a paycheck for life.